if you don't know Randy Lupke, he's well known. I'll give you some of his credentials. He's a registered financial consultant and an independent fiduciary investment advisor with over 35 years of experience. Now, just for those of you who don't know, there's a very small percentage of financial advisors that are actually called independent fiduciary advisors. So of approximately 308,000 advisors in total in the United States, only 1% of them are independent fiduciary advisors, and Randy's amongst that 1%. So that's a pretty good credential right there. He's also a registered mortgage advisor, life insurance agent, real estate broker, mortgage broker, stockbroker, and of course, the owner of Lifetime Paradigm, which is an amazing company. But I met Randy. How I even came in contact with Randy was like 4 or 5 years ago. It's been. I read his best-selling financial book. It's called The Business Owner's Guide to Financial Freedom: What Wall Street Isn't Telling You. So that's the name of the book. It's an amazing book. It's ideal for a small business owner and anyone that's investing. And it helped me with my small business tremendously, which I eventually ended up selling. And so here we go. Let's dive in. Now, my favorite part of this interview is right now. We're going to go into the small business owner section, and then we're going to pretty much be finished after that. So what I loved about your book, let's start with how to value a business. In the book, The Business Owner's Guide to Financial Freedom: What Wall Street Isn't Telling You, it mentions pinpoint the dollar value of your business with a step-by-step formula. What is that formula? Or at least 3 to 4 of the most important factors to focus on for any small business owner to grow the value of their business over time and eventually be able to sell it, which is every business owner's goal, or I would think.
Well, yes and yes. That's a really good place to start. So if you start your own business, most people will start it as an entrepreneur. Maybe it's a mom and pop, or a couple of people, whatever. It's a small business, right? Most people. And so what happens is you're now working for the worst boss in the world, yourself, right? Because your idea of a half day's work is now 6 a.m. to 6 p.m. and you'll work on weekends and holidays, and it's the worst of all worlds, right? And if you're in that situation, I mean, you can still make money. It's still a good thing to do. Don't get me wrong, but ultimately, the value of your business is only worth what you put into it each and every day, right? So you're like a hunter, right? You go out hunting every day and you kill stuff. And sorry for those vegetarians, but you go out hunting and you kill stuff. And at the end of the day, you have to wake up and do it again tomorrow, because that's the only food you have to eat is what you killed, right? If you build a business, right, a business needs to be able to, have its it has to have its ability to run on its own. And the more ability it has to run on its own without you there, the more value you're going to have for the business, right? So, you have brand name recognition, you have market share, you might have some patents, you might have some key customers, you might have all kinds of things that give your business value, even though you're not there, right? So the simple answer to your question is we base it on EBITDA, right? The earnings before right, taxes. It's just basically, I got a net profit, and before I pay taxes, this is what that number is. And depending on how well you've built your business, so that if you weren't there, the money still would be there, then you can get a multiple of that EBITDA, right? So it might be just 1 times, it might be 2 times, it might be 5 times, it might be 15 times. And the answer to which one is it, is based on, again, how effectively you've built an organization that can survive without you being present. Survive and grow.
Got it. So you look at the earnings before interest, taxes, depreciation, and amortization.
Yep.
You want to grow that every single year.
Yep.
But you want to be able to do it without you physically being the one doing it all. You want to be able to step back. Your business is growing its EBITDA, and without you having to actually be there, because nobody's going to want to buy your business if you're doing it all, because if you're not there, then what?
Right.
So that's,
And it goes
does
away.
that
If you're
sound
not
right?
there, it all goes
Yeah,
away. Yeah. And again, we could spend a lot of time talking about this, but that's the bottom line, right? You got to build a business that can build, that
yeah,
can sustain itself, and then the value of your business is a multiple of what that EBITDA is, and that's the
got it.
formula, right? It's that simple.
So if your business has a lot of strong management and it can run itself, it could sell for maybe 10 times its earnings or EBITDA versus if you're doing everything, you may be lucky to get, if you get 1 times your EBITDA. Does that
Yep,
sound right?
that's right. You might be lucky to get nothing, right? You're just walking away,
Yeah.
right?
And that's kind of like valuing publicly traded companies like stocks. Like, if it's a good business you may pay 20 times earnings. And if it's not as good, you may only pay 10 times earnings.
Yeah, kind of. The difference is with the stock market, you're just making a bet that that enough people are going to buy the stock that they'll drive up the value of the stock, and the earnings could go even lower, right? And they're still betting on the
Yeah.
stock. But when you're selling your business, it's Main Street, baby. They're looking at cash,
Yeah.
what they're going to pull out of that business, right? So
Right.
yeah,
Right.
so there you go.
That sounds great. So let's say you're doing great. And I just want to reiterate, like every year, if you're a business owner, make sure you're growing your earnings, your EBITDA. That's so important. But the next point, best way, if your business is doing great, you're hiring more employees. Let's say you're hiring every month. You're increasing what you're spending on advertising. So your business is growing, doing great,
Okay.
but still you're piling up the cash in the business bank account. So what do you recommend they do with that extra cash? They could either, if they're the owner, they could pay themselves more, right, and increase their own salary, or they could maybe open up a taxable investment account at like Vanguard or wherever, and then they can invest through their business rather than investing through themselves. Or what do you recommend they do with that extra cash flow?
Yeah, so you said a few things in there, but let's just focus on that cash, not a flow, but the cash accumulation, the money in the bank account, right? So just like you do in your personal life, we want to make sure you have a sufficient cash reserves in your business to protect you during downsides and to give you opportunities to take advantage of themselves when they come along, right? Um,
Mm-hmm.
the danger of keeping the money in your business accounts, though, is that it's also subject to the creditors, right? So if something does go wrong, if somebody does screw up, there's a lawsuit or whatever, that's what the attorneys are going to go after, right? Now, the good news is with most small businesses, um, they're structured as S corporations, right? So the money
Mm-hmm.
that's in the business checking account really belongs to the business owner anyway. So they can write a check from their business to themselves, no tax consequence because the taxes are already paid every year, right? So why keep that nest egg, that cash reserve inside your business when it puts it at risk? Take it outside your
Yeah.
business, leave just enough operating capital in your business to keep it going. That would be the first thing I'd do, right? And then you mentioned
Yeah.
investing in your business. So if I'm a C corp, I might want to do that. S corp, probably not. I would invest on my again. I would invest as myself, right, individually. You don't have to increase your salary. Remember, as a business owner, especially with an S corp, you're wearing two hats. You're an employee of your business and an owner of your business. So as a salary, I get paid at a W-2, which is subject to self-employment taxes, which is another meeting, another interview, right? And then the K1 side, which is where the profits come out, that's not, right? So you don't have to increase
Yeah.
your salary. You can just take the money out. You can put the money into retirement plans. That protects it from creditors and gives you the tax deductions we talk about.
On that point, what you just said, I love this. There's two things. Number one, so in your book, again, this subject, this is where I learned about the SEP IRA, which is what I set up for my business over the years. And it was really easy to set up. And you can contribute up to 25% of your earnings or 61,000 annually. So what do you recommend for a small business owner? 401k versus a SEP IRA?
Yeah. So again, it depends, right? We'll always begin with that. And so if it's just you and your small business, literally just you, um, the 401k is still going to be the most tax efficient over the SEP. And the reason is, again, I mentioned briefly that you have to have earned income, and earned income is subject to self-employment taxes. And self-employment taxes currently are 15.3%. And it's a 15.3% tax on top of the taxes you pay on your income, right? So it's not just, it's a whole different additional tax, right? So to get
Mhm.
25% of my earnings into a SEP, while it's good that I'm getting the tax, the tax deduction to do it, I had to make $1, right? And then I only got to put in 25%. 401k, I can do 100%, dollar for dollar, up to the first, up to the limit of the defined contribution limit, so which is currently $20,500. So if I earn $20,500, that's all I earn, I could put 100% of it into my 401k and pay no income tax. Still have to pay self-employment tax, but zero income tax. If I put it into a SEP, I earn $20,500. I'd only be able to put $5,000 in the SEP, right? 25% of the
wow.
20. Yeah. So it's more tax efficient to do a 401k. And now it gets much more complicated when you have one employee, right? Because you can do these solo Ks, which is for you and your spouse, you and your spouse and your children, you and your partner, their spouses and your children. All those can be set up for literally free, and they're easy to administer. Again, basically free. But the idea of retirement plans, this is, again, a huge topic. Of all the things I do, and I do a lot of things, as you mentioned, right? Of all the
Yeah.
things I do, the most complicated by far are retirement savings plans. Because the laws, they just keep, it's like, they built a car and then they added this to it and added that to it, and put some band-aids on it and tied some ropes around it. Then they stuck some more stuff on it, and the law just got, it's crazy. They've only been around since 1974, something like that. But the complications and the nuance that surround it are just amazing. And so with the way we approach it is we do a special interview with the business owner to understand, do they have employees, do they have, they have all these little nuanced things, and then we can recommend the best structure, right? Because for some people, it may be a SEP, it may be a simple, it may be just be an IRA. For other people, it's a 401k. Then we have this thing we call a super K. A super K, it's not a real thing. It's a marketing term, but it's a 401k, a profit sharing plan, a cash balance plan, a 401h, and aggregated benefits. It's 5 things bolted together that give people, you mentioned like $61,000, the current defined contribution limit. With a super K, you might be able to put $200,000, $300,000, $400,000, $500,000 into these retirement plans pre-tax. Whoa.
Wow, I never even heard of the Super K.
Right. So again, you yeah, I admire you because you're biting off big chunks of an elephant here, but these are big topics that need a
Got
lot more
it.
depth. So
It's good
anyway,
though. I think just the listeners just hearing these words, maybe they never even heard of SEP IRA or 401k for an individual, and the Super K was the third one.
Super K. Yeah, again, you
Yeah.
type in Super K, you'll find
Oh.
us. It's not an IRS thing, but it's really the combination of defined benefit to defined contribution plans coordinated together to get these big giant contributions. Right.
Yeah, I mean that's the benefit of speaking with a financial advisor, a good one, because you're going to learn stuff that you probably don't even know about, and it's going to pay off tremendously. Or at the very least, go to the library and start reading books, educate
Yeah.
yourself on this stuff.
Yeah.
So real quick, I want to jump into the tax savings options for a business owner. So one thing I learned from Lifetime Paradigm at your team, one of the first times I had a consultation with them years ago, was they taught me about what percentage of a corporation's profit can be taken as a K-1 distribution or like a draw, versus where not having to withhold taxes versus paying it out as W-2 wages where the taxes come out and everything comes out of your check.
Yeah. So you're talking about the salary dividend split, and this is available to S corporation owners, right? So it doesn't work with the C corp. Well, it kind of works with the C corporation, but S corporations. I mentioned this a few moments ago, right? As an S corporation owner, which the preponderance of small businesses are S corporations, you wear 2 hats. I'm an employee. I'm an owner. I'm an employee. I get paid earnings subject to self-employment taxes, which show up on my W-2, and as an owner, I get profits. I get distributions, dividends, which aren't subject to that extra 15.3% tax. So the idea is to pick the sweet spot between how much, let's say I have $100,000 of income, how much of that should be subject to self-employment tax? Certainly not all of it, right? Maybe 40 or 50% of it, right? And then so 40, 50% of it goes to the W-2, 40, 50% of it goes to the profits and distribution, so it avoids the self-employment taxes. And there's a matrix we use that the more you make, the smaller that percentage can be. So if I'm making 100 grand, maybe it's 50-50, but if I'm making 300 grand, maybe it's 30% goes to W-2 and 70% to K-1.
Yeah, that's huge. I mean, no, I
Yeah.
don't think most business owners don't even know about that. And isn't the matrix called the Kohler matrix?
Yeah, my buddy Mark Kohler came up with this, and he owns a CPA firm. He is a CPA, and yeah, again, it's not a law. It's really just a guideline, but it works. And the benefit of Mark's firm is
Yeah,
they filed thousands and thousands and thousands of returns every year, so they know what the risk of audit is, which according to Mark has just not happened. And
yeah,
when they have had audits on other subjects, they look at that and they agree with the amount. So what you're getting at is though that most small business owners are paying too much in taxes, and they're paying too much in taxes because they don't do the salary dividend split correctly, which is
yep.
money in your pocket. They're not using retirement savings plans to help reduce their taxes. If you have a big enough company, we add on things like captive insurance companies to maybe deduct $1 million or $2 million a year pre-tax. So yeah, people pay too much tax. They do, right? And that's a
So that's
large
a
part
good
of
one
our
right there. It's a
business.
great tip. That's a great tip.
Yeah.
Um, we'll wrap this up soon. I have just like basically two more questions.
Oh,
So, do you have
another
any
hour
quick?
then.
All right. Do you have any quick tips on asset protection? Best ways to protect the business assets from lawsuits?
Yeah, in general, right? So obviously you want to operate out of an entity versus doing a sole proprietorship, because this is sole proprietorship or general partnership. All of your assets that you own personally are subjected to all the liabilities of your business. So you build an entity using an LLC or an S corporation or C corporation, right? So
Yeah.
so that's the first thing. You want in general to operate out of an entity, whether again it's a C corp, S corp, or LLC. Second thing is you want to make sure that if you're operating out of an entity, you treat it like one and you don't commingle funds. So you're going to have separate checking accounts, maybe separate credit cards. You're going to operate like a business. You're going to have board meetings. You're going to have annual shareholder meetings. You're going to file, do all the stuff to operate correctly. Because if you get in a lawsuit, which happens, the first thing the attorney is going to do is they're going to sue you personally and your business. And this is almost always going to happen. And you have to prove they're trying to prove something called alter ego, which basically says that even though you have an entity, it's no different than you. You and your company commingled funds. You went out to dinner. You did all this stuff. You didn't act like a business. You didn't have your own checking account, whatever it was. They're going to look for a little loophole to make that business and you be the same person. That's alter ego. And then they'll get at your personal assets. So you want to, if you're going to build a business, run it like a business, act like a business, separate checking accounts, regular meetings, da 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 da. Uh, little little side tip here: when you sign things as an S corporation, you don't sign it as Paul Paquin. You're going to sign it as Paul Paquin, president of my company, right? So Paul Paquin, pres, not Paul, because Paul Paquin, the person. Now you've commingled you brought you as a person into your business. So that's when you're signing contracts or anything. You always want to, but comma
That's a
president.
good one.
Yeah, yeah.
I never even knew that.
Yeah, attorneys will look for any little crack in the armor, right? And they don't need a big crack to create a big enough problem that you're going to get dragged into court. People go, "Oh, I have a corporation. If I get sued, all my assets are protected," until they find out that they're immediately sued themselves personally. And even though you have a corporation, you've done all the things right, you still have to prove to the judge that there's no alter ego, right? So anyway, that's the first thing.
Yeah.
Yeah.
All right.
Second thing is, of course, be a good operator, right? Do the right things,
Okay.
treat your client, good golden rule, that kind of stuff. Real estate, there's a whole bunch of rules I have for that. Be a good landlord. That's the number one thing. That means, screening your tenants, listening to them, fixing up your property, have good insurance, possibly put it inside of an LLC, right? So there's a number of different things. So different assets have to be protected in different ways. Right. That's what I get down to.
Sure.
I always come back to this. It depends, but it really does depend on so many things. And that's why we have, the conversations with our clients, because we got to understand their circumstances. And once we understand their circumstances, we can give them the right recommendations.
Hey, they were some good tips you just gave on the asset protection.
That was a
So
mouthful,
thank
huh?
you. That was good though. Thank you.
You're
And
welcome.
then now it's time. Okay, what everyone dreams about. It's time to sell your business. Couple things here. Do you recommend a stock sale or an asset sale? I don't think most people even know the difference.
Yeah, so I can describe the difference really quickly and easily. So, a
Okay.
stock sale means they buy your company. They buy the shares of your company, right? When you formed your S corporation, you probably don't remember it, but you got your little corporate kit, articles of incorporation, board of directors, shareholders.
Yeah,
Oh,
don't
shareholders.
lose that, by the way. Don't
Yeah,
lose
don't
that
lose that,
kit when
but
you incorporate, like I
yeah.
did.
Yeah, you need that kit because that again, you got to operate like a business, right? So if you sell, if you have a stock sale, they're buying your business, right? They're buying the stock of the business, the ownership of it. They get the furniture, fixtures, equipment, they get the contracts, but they also get unknown liabilities, right? They don't know if you did something bad in the past, if a customer is going to come up from the past into the future and sue them, so they don't know what the unknown is. It's not known, right? So for the most part, a buyer wants to buy an asset purchase. They want to buy your company through an asset purchase. They want to buy your furniture, fixtures, equipment, your contracts, your goodwill. They want to buy all that stuff only. They don't want anything to do with owning the company because then they have these unknown liabilities. Problem is, this is the problem. As a seller, I want to sell my company because it's more advantageous to me stock or tax wise. But again, as a buyer, I always want to do an asset purchase because it protects me more, right? So immediately when you start out selling your company, you have this conflict. There's more tax
Yeah.
advantages for the buyer. When the buyer buys stock, all of those equipments and cars and stuff that you fully depreciated, they're still fully depreciated to them. But if they did an asset purchase, they get to start all over, get fresh write-offs. They put a line in the sand between you and your past mistakes, right? So they want an asset purchase, you want a stock purchase, and there's ways to mitigate that. Which again we can go into another day using trusts, various trusts. We can do that, but in general, you're going to be selling your business as an asset sale.
Yeah, I
That's
like the stock sale option because, well, maybe you can do the same with the asset sale. But like, for example, if you have capital gains from selling your business, you can offset those gains by using tax loss harvesting and selling stocks that lost money. So
Yeah.
you can actually use tax loss harvesting to offset the capital gains if you go the stock sale method, or can you do that with asset
Well,
sale as well?
really, again, rather than go down the rabbit trails, let's just say there's advantages, disadvantages to both, and
Okay.
ultimately that's what you got to look at. Is look at the end of the day, am I getting more money if I do a asset sale versus a stock sale with all the deductions and things taken into consideration? It's not the sticker price; it's what you get to put in your pocket at the end of the day, right? And what you get to put in
Yep.
your pocket is after paying the attorneys and the tax man, right?
Yep.
And that's the way you got to look at it. So, yeah.
And one last point that I like the I know this gets super complex, but I like the idea of when you sell your company, instead of getting the money yourself as the owner,
Yeah,
you can set up a trust,
right.
basically transfer the ownership of your company to the trust, and then you're selling your company, but the trust is getting paid. And from there, you have ways where, like a deferred sales trust account, you can defer the taxes, the capital gains, and invest the money in the trust into whatever investments you want. Do I
Yep.
have that about right?
You have it exactly right. And again, I mentioned this briefly because it's a big subject, but you use trust to sell the assets, and that way you capture the taxes inside the trust. That's what you're doing.
Yeah, so there's a lot
Yeah.
more on that, but this stuff you just got to hear about it. I mean, and
Yeah.
that's why I'm getting it out there. But this was amazing. I mean, Randy, do you have any other anything you want to let our listeners know about, how to find you, or
hmm
whatever you want to share with them?
Sure. The best way to find us is to go to our website, right? There's a ton of free stuff there. Videos, recordings, interviews like this, just a ton of stuff, right? So that's lifetimeparadigm.com. And I know it's hard to spell. So lifetime, Lifetime. Everybody gets that. Paradigm's a toughie. Paradigm, lifetimeparadigm.com. Um, Again, there's just so much knowledge there that we give away for free. Past blog articles and just that's the best way to do it. And then if there's some specific interest you have, you can from the website you can schedule an appointment with us, and that's typically how we get the relationship started. We spend not a lot of time, about 15 minutes to really see if there's a match. you have needs, and we have opportunities to help you. And if there's a good match, then we can, take you down the right path. But that's how it's. Just go to my website. Go to my website, Paul. Thanks for offering that.
Awesome. I'm going to leave the link in the description of this video.
Oh, perfect.
And again, this is Paul Paquin, Randy Lukey. It's been a lot of fun, everyone, and I hope you learned a lot. And you know, go ahead and share this video with everyone else that may be interested. So thanks a lot, and have a great day, everyone.
Thank you. You're welcome. And we're probably up to 7 degrees now. I'm going to bundle up and go skiing.
Oh man, you're going skiing today?
Yeah, I am. As soon as I'm done with you.
It's right outside where you live, right? Like you can walk there.
Yeah.
Oh man.
Yeah, right across the street.
Fun.
So. All right, buddy. Take care. It was
amazing.
Good talking with you, Paul.
Good speaking to you. Thank you so much.
You're welcome. Bye-bye.
All right, bye.